Ever wondered how professional investors truly assess a company's worth beyond fleeting stock prices? Today, we're diving deep into the discounted cash flow model, a powerful analytical tool that will fundamentally change how you view investments and empower you to make more informed decisions. At its core, DCF is a valuation methodology designed to estimate the intrinsic value of an asset or business. It's not about market sentiment or quarterly earnings reports. It's about the fundamental economic engine of a company. This model provides a robust framework for understanding a company's true worth. Imagine it as a financial crystal ball, projecting the real cash a business will generate over its lifetime. We focus on free cash flow, the actual money available to shareholders and debt holders after all expenses and reinvestments. This is the purest measure of a company's financial health and value creation. To truly grasp DCF, we must first internalize a foundational economic principle, the time value of money. This concept dictates that a dollar today is inherently worth more than a dollar tomorrow or a year from now. It's a critical analytical component. Why? Because money in hand today offers immediate purchasing power and, crucially, the opportunity for investment and growth. Future money, conversely, carries opportunity cost and the risk of inflation eroding its value. This economic reality underpins all sound financial analysis. Therefore, to compare future cash flows with today's value, we must discount them. This process mathematically adjusts future sums to their equivalent present-day worth, reflecting their reduced value due to time and risk. It's how we standardize value across different time periods. Consider a straightforward scenario. A friend promises you $100 one year from now. Would you value that promise identically to receiving $100 today? Intuitively, no. The future payment is less valuable. If your personal investment hurdle rate or expected return is 10%, then the present value of that future $100 is approximately $90.91. This means that $100 received a year from now is economically equivalent to having $90.91 in your pocket today, given your investment opportunities. This simple example highlights the power of discounting. This principle is precisely what we apply in the DCF model. We begin by meticulously forecasting the free cash flow a business is expected to generate over a specific projection period, typically 5 to 10 years. This requires deep analytical insight into the company's operations, industry, and competitive landscape. Once these future cash flows are projected, each year's cash flow is then discounted back to its present value. We use a carefully determined discount rate, which we'll discuss next, to perform this crucial adjustment. The sum of all these present values gives us the intrinsic value of the business today. So, what exactly is this discount rate? Analytically, it represents the cost of capital for the business. It's the minimum rate of return investors expect to earn for providing capital to the company, considering the inherent risks involved. This rate is a critical input in the DCF model. For a company, this rate reflects the blended cost of its equity, what shareholders demand, and its debt, what lenders charge. It acts as a hurdle rate. The company must generate returns exceeding this rate to create value for its investors. A higher discount rate implies greater risk or higher opportunity cost, leading to a lower present value. Let's consider a practical example to solidify our understanding. Imagine a company projected to generate the following free cash flows. Year 1, $100 million. Year 2, $120 million. Year 3, $140 million. If our chosen discount rate is 10%, we would calculate the present value of each of these future cash flows. By dividing each year's cash flow by 1 plus discount rate, raised to the power of the year number, we convert them into today's dollars. The sum of these present values, along with a terminal value representing cash flows beyond the explicit forecast period, constitutes the DCF value of the business. This provides a concrete, analytically derived valuation. The power of DCF becomes evident when comparing its output to the market's current valuation. If our calculated DCF intrinsic value for a company is, say, $400 million, but its current market capitalization is only $300 million, this suggests the stock is potentially undervalued. This signals a potential investment opportunity. Conversely, if the market capitalization stands at $600 million, the stock appears overvalued according to our fundamental analysis. DCF helps you cut through market noise and emotional trading, focusing solely on the underlying economic reality of the business. It's a cornerstone of value investing. DCF is paramount because it helps you understand the intrinsic value of a business based on its fundamental cash generating ability, not speculative market sentiment. It removes emotional biases and focuses on quantifiable future cash flows, providing a disciplined approach to valuation. This analytical rigor is invaluable. However, it's crucial to acknowledge that DCF is only as robust as its inputs. Overly optimistic growth assumptions or unrealistic discount rates will lead to biased valuations. Therefore, skilled analysts often cross-reference DCF results with other valuation methods, like relative valuation, to ensure a comprehensive assessment. So, why do we meticulously discount future cash flows? The fundamental reason is that future cash is inherently uncertain, carries greater risk, and is less valuable than cash available today. Discounting mathematically incorporates this reality into our valuation. It's an essential adjustment for risk. DCF is the analytical backbone of value investing, a methodology championed by legendary investors like Warren Buffett and Charlie Munger. For anyone aspiring to be a proficient financial analyst or a savvy investor, mastering the DCF model is not merely an option, it is an absolute necessity. Now that you understand the profound impact of DCF, it's time to put this knowledge into practice. Start by researching a company you're interested in and try to identify its key cash flow drivers. Dive deeper into financial statements to understand how free cash flow is generated. Don't just observe the market, analyze it. Share your insights and questions in the comments below. And let's build a community of informed investors.